Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Friday. If this is your first time seeing one of my videos, welcome to my channel where I'll try to demystify all things mortgage related. If you find this content helpful, like and subscribe. So this week was a rough rate week. After last week was the first good week for mortgage rates. This was the worst week we've had for mortgage rates in over a year, at least as of this recording. Rates have rebounded a little bit so far today, but they're still currently as bad as they've been in the past 12 months over a week to week's time frame. The reason for this, it wasn't a real mystery week where rates moved and there wasn't a clear explanation. This time there was. You had a combination of economic data showing the economy is still moving rapidly. We're not slowing down. We saw retail sales on Tuesday come in a lot hotter than expected, and initial jobless claims on Thursday came in lower than expected. On top of that, on Wednesday, we had a couple reports on new builds that were right as expected, and that didn't really change rates much. But then you had President Biden announce a $100 million package towards Israel and the conflict in the Middle East, and rates got a lot worse after that news. And what's interesting is right now, the CME Group is projecting that we are most likely not going to have another Fed rate hike this year. And that probability has increased of 2 more pauses rather than another quarter point hike, which had been a distinct possibility. However, rates have gotten worse. And I believe the reason for that is even though the short-term prospects of what the Fed is going to do are getting better, the longer-term outlook seems to be getting worse. And I think it's a combination what I talked about last week with inflation and shelter specifically seeming to be a little stickier than I initially thought. And on top of that, now any kind of increase in government spending, it's not going to have an immediate effect, but it could have a trickle-down effect in the long term and also contribute to inflation being higher for longer. And if inflation is higher for longer, the Fed is going to keep their rates higher for longer. And if it gets bad enough, if it goes up, inflation has been steadily coming down. If it goes up, we could see another rate hike in the future. So next week, we've got 2 key pieces of economic news that I could see affecting mortgage rates. We have another initial jobless claims report, and then we have PCE, which is the Fed's preferred measurement of inflation. It comes out later than CPI, and it's about the previous month, September. So it's usually not as big of a market mover, but it's still worth following, and it could still move rates one way or another depending on how it comes relative to expectations. As always, if you have any questions, shoot a comment below or call or text me on my cell phone. But thanks for tuning into this video, and I will see you next time.